$4 trillion came back in just 30 hours. Let that sit for a second. After one of the ugliest crashes metals have seen in years, gold and silver didn't slowly recover. They didn't hesitate. They snapped back. Hard. Gold climbed back near 4,900. Silver jumped back toward 90. Trillions returned while most people were still staring at their screens in disbelief. And that timing matters more than the numbers themselves. Because that money didn't come back when things felt calm. It came back while fear was still everywhere, while people were still shaken, while many had already sold because they couldn't take the stress anymore. That tells you something important. This wasn't a normal sell-off, and it wasn't a normal bounce. What happened on the way down wasn't people calmly changing their minds. It was forced selling, accounts hitting limits, rules kicking in, traders being pushed out whether they wanted to sell or not. Anyone who's ever been forced to sell something knows how that feels. You don't sell because you think it's a bad deal. You sell because you don't have a choice. That's what last week looked like. Too many positions, too much borrowed money. Then conditions changed. And when they did, everything unwound fast. Prices fell quicker than people could react. Screens went red. Panic spread. But panic doesn't last forever. Once the forced selling ends, the market gets quiet for a moment. And in that moment, real buyers step in. That's exactly what happened here. Silver didn't drift back up. It jumped. Gold didn't slowly grind higher. It surged. $4 trillion rushed back and almost immediately. Regular people didn't do that. Most people were still processing what just happened. Some were still angry. Some were scared to touch the market again. Retail doesn't move trillions in hours. This rebound came from buyers who were waiting. And you could see it not just in prices, but in behavior. While paper markets were chaotic, physical demand didn't disappear. In fact, it picked up. Vaults saw metal leave. Premiums stayed higher than normal. People were still buying real gold and silver even as prices were falling. That's a big clue. When prices fall and buyers vanish, that's fear. When prices fall and buyers show up anyway, that's conviction. Think about it in simple terms. If something you use every day suddenly goes on sale because a store has to clear inventory, you don't assume the product is broken. You assume it's an opportunity, especially if you know you'll need it again. That's how a lot of real buyers looked at this move. Gold and silver aren't just numbers on a screen. They're real materials with real uses. They're held by central banks, used in electronics, used in energy systems, used as long-term stores of value. None of that changed last week. What changed was who was holding positions. The crash pushed out people who couldn't handle volatility, who were stretched too thin, who needed everything to go right all the time. Once they were gone, prices stopped falling, and the rebound showed who was still interested. This is where many people misunderstand volatility. They think big moves mean something is broken. Sometimes it means the opposite. Sometimes it means the system just flushed out excess. Volatility is uncomfortable, but it's also how markets reset. And right now, markets everywhere are under pressure. Bonds are shaky. Currencies are moving fast. Governments are dealing with debt levels that don't have easy solutions. In times like that, money behaves differently. It doesn't always chase growth. Sometimes it looks for stability, for things that don't depend on someone else keeping a promise. That's why gold and silver act the way they do during stress. They don't move because people are excited. They move because people are uncertain. And uncertainty is very high right now. That doesn't mean prices only go up from here. There will be swings. There will be pullbacks. Anyone saying otherwise isn't being honest. But what the last few days showed very clearly is this. The underlying interest didn't disappear. It was waiting for the selling to stop, waiting for prices to reflect something closer to reality. And once that moment arrived, the response was immediate. That's why this rebound matters. Not because it guarantees anything, but because it tells you who is still paying attention. The loudest voices during crashes are usually fear-based. The most important moves happen quietly, in who steps in when others step out. $4 trillion doesn't move by accident. It moves with intention. And when you see that kind of response after a violent shakeout, it's a signal worth respecting. Not to rush, not to panic, but to understand. Because markets rarely give clear signals in calm times. They give them during moments like this, when emotions are high and clarity is low. And once you understand that, you stop reacting to every headline and start watching behavior instead. That's where the real story always is. When you zoom out, what's happening starts to make more sense. This rebound didn't show up because people suddenly felt optimistic. It showed up because a lot of pressure had been building quietly for a long time, and the crash was the moment that pressure finally released. For years, the system has leaned heavily on paper markets, contracts, promises, numbers that move faster than anything physical ever could. Most of the time, that works. Prices move up and down, traders make money, life goes on. But every so often, stress builds underneath that surface. Debt grows, governments borrow more, interest rates move. Old strategies stop working the way they used to. When that happens, markets don't break all at once. They crack in places first. Gold and silver tend to feel those cracks early, not because they're special, but because they sit outside the system. They don't rely on someone else paying you back. They don't need earnings reports or growth projections. They just exist. That's why they get hit so hard during liquidations. When traders need cash fast, they sell what they can sell. And gold and silver are easy to sell. But that's also why they bounce so fast once the selling stops. Because when people step back and look around, they realize the reasons they wanted them in the first place didn't go away. Think about what didn't change last week. Governments didn't suddenly become less indebted. Currencies didn't suddenly get stronger. The world didn't suddenly need less energy, less technology, or less infrastructure. If anything, those pressures are increasing. So when prices dropped hard, it wasn't the end of a story. It was a reset inside it. This is where behavior matters more than predictions. When markets fall and everyone walks away, that's a warning. When markets fall and buyers line up quietly, that's information. We saw the second one. Physical buying didn't stop. In some places, it picked up. People were still taking delivery, still adding to holdings, still willing to pay a bit more to get the real thing instead of a promise. That's not speculation. That's preference. And preference is powerful. It means people are thinking beyond the next trade, beyond the next headline. They're thinking about what they want to hold when things get unpredictable. This is also why the rebound happened so quickly. Once the forced selling ran its course, there wasn't much supply left to push prices lower. Sellers were exhausted. The panic had done its damage. What was left were buyers who had been waiting patiently. That creates sharp moves. It doesn't mean the ride will be smooth from here. Markets rarely are after something like this. You'll see swings. You'll see days that feel confusing. That's normal. But the character of the market has changed. The weakest hands are gone. The most stretched positions are gone. What remains is a market that's thinner and more sensitive. That sensitivity cuts both ways. Prices can move up quickly, but they can also dip suddenly. That's part of the process. What matters is the floor. And the floor right now isn't set by emotion. It's set by need. As long as physical demand stays steady, as long as people keep wanting real metal instead of just exposure on a screen, there's a limit to how far prices can fall before buyers step in again. That's what we just witnessed. This is why it's important not to confuse noise with direction. Headlines will keep changing. One day it's metals are finished. The next day it's metals are back. That back and forth is designed to keep attention, not provide clarity. The clearer signal is always in who's acting when things get uncomfortable. Last week, many people sold because they had to. Others bought because they wanted to. That difference is everything. And it's not about being right or wrong in the short term. It's about understanding what kind of market you're in. Right now, we're in a market where confidence is being tested, where long-standing assumptions are being questioned, where money is moving carefully, not blindly. In environments like that, assets tied purely to growth can struggle. Assets tied to stability tend to get attention. That's not a prediction. It's a pattern that's shown up many times before. The mistake most people make is reacting emotionally in the middle of it. Selling because prices fell, buying because prices rose, chasing the last move instead of understanding the bigger picture. What the last few days showed is that big moves don't always mean something is broken. Sometimes they mean something is being repriced. And repricing is rarely gentle. So if there's one thing to take away from this, it's not a price target or a forecast. It's perspective. Markets can drop fast. They can recover fast. What matters is why they do both. This rebound wasn't random. It was the release of pressure after forced selling. It was buyers stepping in when prices crossed into territory that didn't line up with reality anymore. And once you see that, you start watching markets differently. You stop asking, what does the headline say today? And you start asking, who is acting and why? That's where the real information lives. And that's how you stay grounded when everything else feels noisy.